Hi everyone, welcome to the audit and attestation class. In this class of assessing the risk and developing the planned response to those assessed risks, we'll be covering the topic called Statement on Standard for Accounting and Review Engagement. In short, it is called SSARs as well. So let's dive into to understand more about SSARs. So in this control environment, so we have one more important thing is safeguarding of assets. So we are at fifth component of COSO, in which it is being monitoring of controls. So monitoring of control, what all things will be as an auditor we need to keep in mind. Understanding like design and operating effectiveness of the internal control is primarily the responsibility of management, but as an auditor, when we are reviewing the monitoring of control, what all things we need to keep in mind. So first is identifying the controls that is relevant for the reliable financial reporting framework. Keep in mind materiality, size, nature, diversity, complexity, legal, regulatory environment, complexity of the system. All those things we need to keep in mind, and all IPEs also we need to keep in mind. Then the next thing is monitoring of control includes safeguarding of asset as well. Right? What is safeguarding of asset? Basically, internal control over safeguarding of assets against any unauthorized access to the assets, right, may include relating to the financial reporting. So when we say it's like safeguarding of assets, so it includes both your physical assets as well as your, you can say, intangible assets, or you can say your company's informations, reports, documents, and database also, right? So when you are saying safeguarding of assets, do we have appropriate and sufficient controls to protect your physical as well as your intangible assets? So physical assets may be your inventory, maybe your fixed assets, maybe your computers, laptops, so on and so forth, right? So you can just imagine a company. So you, in the physical assets, you may have your assets, you may have your inventories, you may have your stationaries, you may have some marketing materials, so on and so forth. So how the overall controls you have in your organization, which will be protecting those physical assets. That means physical access control, like most of you are working in a big company. So I'm sure you all might be having your badge to get like access in your company, right? Do you all have like access badge to get into your
that
company?
ID card and all access,
right? Your ID card and access card. So that's like a control that your company has put, like only like authorized people can come in, right? Same way, have you seen like IT room in your company?
yes, so the server room
Right?
is there.
Server room or IT room of your
Yes,
company, right? So in
yes,
that, maybe your ID card, your access card will not work. So only to
that
limited
is what.
authorized
Yes,
people who are working in IT domains relating to the server, they will get special access for those IT rooms or server room, right? Same way, if you look at like production, big production or manufacturing company, so they are also giving like different card to the corporate office. People who are working in corporate office, they will have access to the corporate office gates only. But when they go to the production house, they need to take a special approval and special pass for that, right? So that is called like physical access control. And then you have like, you might have seen like security guard sitting outside your office, right? Have you seen? You have security guards outside your office,
Yes,
yes,
sir.
sir, yes, sir.
right? You have maybe like some of your company might having CCTV camera as well in the lobby, in the staircase, and the front desk, right? So
Yes,
those all are physical controls, like who is coming in, who is going out, right? If you see like the government agencies, like for example, police department, or if you see like raw department, if you see, you can say this are military agencies. So when they have like their IT rooms or their internal rooms, there they have like multi-level of securities as well on physical control. You know, have you heard about data tiles?
data dice.
Data tiles, yeah.
No, sir.
No.
So yeah, so in in raw or in all this security agency which are Ajit Doval. Have you heard him? Ajit Doval. His
Yeah,
team, right?
India
Yes, sir.
James Bond.
Yes, yes.
Yeah. So
Double O
where
7, India double O 7.
Yeah.
yeah. So in his office where his teams actually work, they have like big security room and data room, right? There they use data tiles. What is that data tiles? They no unauthorized person can even step in the room. Maybe in movies like you might have seen जहाँ पे the gangster or maybe like डाकू जो loot करते हैं kind of for Kohinoor diamond or
Hmm.
something like that, right? You might have seen those rooms, right? There are laser lights which are
Right.
protecting,
Yes,
right?
yes, yes.
So those kind of protections are called physical protection of your data, assets, and your inventories. Right, same way data tiles is a new concept actually. To be very honest, like this is just launching in India. Only
Okay.
one company in India work on data tiles, and luckily he's a good friend of mine.
Oh, okay.
So they have developed like this data tile, like anyone, the camera everyone can see, but data tiles, these are like tiles on your floor, which nobody can see. Right, when you put your step into the tile, they will scan your body completely, and they can you can say identify your identity, so whether you are authorized to go there or not authorized to go there.
I think Ocean's 11 के अंदर it was this concept was shown way back. I think maybe.
Yeah, so in India,
Yes.
like one of my friend is working on this, and he has developed those data tile, and they are giving it to Ajit Doval's team.
He's working with Ajit Doval now.
Yes, like not directly, but
But
with
yeah,
his,
he some part. Okay.
yeah, can you imagine? So those things are now like is again like safeguarding of your assets, safeguarding of your data, maintaining the security, right? So now coming back, about again picture or movie, let's come back to the audit section. So these things to protect the assets. One is physical control. Second is access control or logical control, right? So you may have access, like some of you are working with EY, or some of you are working with like other big four consulting firm. So you will get access to those audit files only for which you are working. Like for example, if somebody is working in account payable team, right, they will get access to all the database as well as system which is required to perform your duties, right? You will not get access of payroll, you will not get access of maybe marketing material, you will not get access of inventory, right? So the respective people has been given respective access control, so that's called system control, to protect and safeguard the assets and information of the company. So that all come under the safeguarding of assets. Now let's look at the theory side, then you can correlate both the example like physical control and access control or logical control. Internal controls over safeguarding of assets against the unauthorized access may include control relating to financial reporting. Primary objective to consider the control relevant to the audit is whether and how a specific control prevent, detect, and correct a material misstatement in class of transaction, account balance, disclosure, and their relevant assertion. So here, what is the key thing when you are looking at any control? Whether that control is a preventive control, is it a detective control, or does management take timely action to correct if there is any material misstatement? So these three things you need to keep in mind when you are evaluating any controls. You know what is preventive control? Any idea?
Yes, sir.
Yeah, what are those?
Sir, any control that can help in preventing the misstatement or misstatement to happen in the first place. So those are called preventive controls, and detective is wherein it's already happened, but somebody is going to detect it.
Yeah.
So
So like the
That's
example of the access card was a preventive control.
Yes,
Yes.
absolutely true. Have access card as well as like
Hmm.
access to your system, like you are
System,
getting
right.
like AAP team member is getting only access of AP related accounts, right? PPNA team member is getting access relating to PPNA account. Production department is getting access relating to production activity. Payroll department is getting an access relating to payroll activity. Most of the IT controls are preventive control, right? And what is detective control?
So when something has happened, a material misstatement has occurred, and then there are control that now when we pass through this particular process, we will be able to detect that this misstatement happened. That is a detective control mostly.
Yeah. For example,
so like controller is reviewing a reconciliation.
Yes.
So,
yeah.
you know,
That's a detective control. Yes.
Yeah. Same way like reviewing bank reconciliation,
Yes.
AR aging, right? Provision for obsolete inventory. These all are detective control, which is being framed to detect if there is any misstatement in that process. And then correction of material misstatement. That is also very important for an auditor to understand. So once any misstatement is being identified either through preventive control or through detective control, how timely management react to those misstatements and how timely management correct those misstatements. So that shows like management philosophy toward those misstatements, toward those controls. So as an auditor, we need to understand how proactive management is to correct if there is any misstatement identified or any weakness in the control identified, to correct those relating to class of transaction, account balance, disclosure, and the relevant assertion. For example, like purchase and payable process, that segregation of duty. So whether like purchase requisition is prepared by someone and is approved by someone else, right? Then purchase requisition, approved purchase requisition go to the purchase department, and then purchase department make the purchase order and approve the purchase order, right? So they all are a segregation of duty. So store department will do requisition, purchasing department will make purchase order, and AP department will approve the invoice, right? And treasury department will make the payment. So it's a clear-cut segregation of duty among respective 4 departments, right? That is called segregation of duty within the team as well as within the different departments to deal with the respective transaction. Then next is like, for example, authorization metrics. For example, purchase order up to, let's say, $100,000 can be approved by the purchase manager. But if they need to issue purchase order for more than $100,000, they require an approval from the controller, right? So then that's an authorization matrix. Up to $100,000, that purchase manager or purchase head can individually sign and approve the purchase order. But if it is more than that, then it is required controller approval. Same way, let's say for payment, up to 10,000 payment, single person can sign off, right? Respective cashier can sign off. If the payment is more than $10,000, then it required 2 people sign off, like the cashier and his supervisor. Make sense? So these all comes under the authorization matrix. Who is authorized to approve to what amount? Make sense?
yes, sir.
Yes, sir.
So now let's quickly go through like P2B process really quick. We have already gone through many a time. Purchase requisition authorized by production department, right? Vendor selection and approval by purchase department. Purchase order generation and authorization by purchase department. Good receipt note approved by the inventory or store department. Then good receipt of invoice is approved by accounts department, account payable department by doing a 3-way match, and then payment is authorized and approved by the treasury department, right? This we have gone through many a time. I'm not investing much time on it. So we have covered all 5 components of COSOs. Now, like audit of issuer. So when you are conducting an audit of issuer, you will be issuing an integrated report, right? Integrated audit report required the compliance of PCAUB standard 2201. So that is a PCAUB standard for the integrated audit report, in which you are required to compliance to test the design and operating effectiveness of the internal control. PCAUB standard 2201 provide guidance on the requirement to express an opinion on the effectiveness of the company's internal control over the financial reporting framework. If internal control deficiency exists, if when you have done the internal controls audit and you have found out any deficiency, whether it's a significant deficiency or a material weakness. So there are three categories of deficiency, right? Do you remember in last week we discussed three types of deficiency: routine deficiency, significant deficiency, and material weakness. What we do for routine deficiency? We communicate to the management, right? What we do with the significant deficiency? We qualify the report. What we do with the material weakness?
Withdraw.
No, it depends. If there is a scope limitation, then only withdrawal. Otherwise, an adverse opinion on internal control. Because material weakness means it's a persuasive impact. Hope you remember those three terms. You remember from last week class? Three kind of deficiency: routine deficiency, significant deficiency, and
Material deficiency.
material weakness. Not deficiency, material weakness. Right? So if there is a routine deficiency, then you will be giving a recommendation letter to the management to improve upon. If it is a significant deficiency, then what you will do? Qualify the
Qualified report.
report on internal controls, right? And if it is a material weakness, then
Adverse opinion or withdrawal as per the situation.
yes, if like there's a scope limitation, then you can withdraw. Otherwise, adverse opinion on the internal controls, not on the financial statement, right? But these may have impact on financial statement. So as an auditor, you need to evaluate the impact on financial statement as well. If they are impacting financial statement as well, and the impact is on single or one or two line item, then qualified opinion. And if impact is persuasive, then adverse opinion, right?
Okay, sir.
So if internal control deficiency exists, the auditor should consider whether there should be higher risk of material misstatement due to fraud. So here professional skepticism should apply. If controls are not effective or auditor decided not to rely on control, then auditor should obtain more persuasive evidence from substantive procedure. So for example, if you are doing an audit of non-issuer, when you are doing audit of non-issuer, test of control are not mandatory, right? You all agree to it? But you have taken a call, to follow the test of control approach so that your substantive procedure would be less, right? As an auditor, you can take a professional judgment call to follow the control reliance approach, and you can test the control, and if you gain the comfort by test of control, then your substantive procedure is less. But if you are not planning to rely on control, or if the control initially you have planned to rely on control but they are failure, then you need to work more on the substantive audit procedure. Then you need to test more details through the substantive testing procedure. Now coming to the issuer side. Issuer side, it is mandatory when you need to issue an integrated audit report, right? If you have to issue an integrated audit report, in that case of scenario, you have to test the control, right? When you are testing and you have found controls are not working as they are designed, then what you will do to gain the comfort on the financial statement, you will be extend your audit procedure on the substantive test of detail, which include your analytical procedure and testing of detail. That is inquiry, inspection, vouching, verification, observation, right? You can give a qualified report on the internal control, but it does not mandate you to give qualified report on the financial statement as well. So there's a clear-cut difference. So if there is a control deficiencies, if there is a control failure, you can give qualified opinion or adverse opinion on internal control. But it does not mean you need to give a qualified or adverse opinion on the financial statement audit report as well. For that, you can extend your substantive procedure, and if you gain the comfort through the substantive procedure, then no qualification or modification required. But by extended work also, you will gain a lot of misstatement. Then accordingly, you will decide on the qualification or adverse opinion or disclaimer of opinion, as the case may be for the financial statement as well. But just by deficiency in the control, you cannot qualify the financial statement audit report. Make sense?
Yes, sir.
Koi doubt? Any doubt?
No.
Cool. Okay. So if controls are not effective, so we discuss that. Now we have discussed on audit side. Now coming to the accounting and review engagement. What all things we need to do? For preparation, compilation, and review engagement, we need to follow SSARs, right? We all know for preparation engagement and compilation engagement, no independence required. But for review engagement, independence is required. For preparation and compilation, no verification is required. But for review engagement, you need to do the inquiry procedure and analytical procedure, right? For the preparation and compilation engagement, only understanding of financial reporting framework is required. Whereas to conduct the review engagement, you are required to have an understanding of financial reporting framework, accounting principle and practices as well, followed by the management. And in terms of level of assurance, no understanding of internal control required for preparation and compilation engagement. In review engagement, if you are doing review of the issuer, then understanding of internal control is required. If you are doing review of a non-issuer, then understanding of internal control is not mandatory. Last point is no assurance in case of preparation engagement or compilation engagement. In preparation, you do not issue any report. In compilation, you issue compilation report where you clearly mention no assurances being provided. Whereas for review, you are providing limited assurance report. Right? Make sense?